Good morning. Welcome to Stock Market Today. It's Wednesday, March 18th, 2020, and I am your host, Dan Russo, Chief Market Strategist at Chaikin Analytics. You can find me on Twitter, as always, at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where we get a lot of the content for this show. Hit your inbox every trading day before the market opens. So U.S. equities finished higher in volatile Tuesday's trading after suffering their biggest loss since the 1987 crash on Monday. All sectors were higher, but it's interesting to note that defensive sectors outperformed. Energy lagged once again. Treasuries were weaker with the curve steepening. The dollar was stronger on the major crosses. Gold was up 2.6%. WTI crude down another 6%, in case you were thinking about even sticking your hand out and catching that knife in energy. As we get to the desk this morning, though, futures are trading limit down as two-way volatility continues in this market. Asian equities were weaker overnight. Australia, South Korea, and Hong Kong leading to the downside. European markets are under pressure. Treasuries are also under pressure, though. And that, to me, is the biggest takeaway over the past few days. Equities are in a downtrend. We know that. We've been talking about it. We've been looking for signs of a stabilization. We haven't seen it yet. Treasuries are under pressure now. Folks, it's a dash for cash. Cold, hard cash. Cash appears to be king. Dollar is weaker on the yen cross. That's a safety trade, but stronger against the other currencies. Gold down 2.2% and WTI crude off another 4.5 today. Taking a look at the structure of the S&P 500 here, we still continue to hold the 2018 lows. Should we break those, we have to start thinking about 2100 to the downside. People are starting to do their retracement levels off the move from 2009. Never thought we'd be doing that, but we are. And what's interesting to me is the 2018 low lines up with a 38.2% retracement of the advance from the 2009 low to the 2020 high. So limit up, limit down, and on and on. A lot of volatility out there. 2018 lows are in play, 2100 level if that fails to hold. Resistance, I mean, we could, in theory, rally 20% here and still be in a downtrend. So let's just call resistance near the 2800 level for now. RSI holds bearish ranges. Chaikin money flow is neutral with a bearish bias. So we are and continue to be looking for signs of a less intense low. I know I keep saying it. I really don't care. I'm going to keep saying it. I'm not going to stick my hand out and catch this knife. People reach out to me, hey, don't you think this is the bottom? Hey, I'm going to buy some stocks here. And if that works for you, that's great. That's not my process. And I'm not going to change my process just because the environment's changed. I'm going to look for a less intense low. There are folks out there who like to catch the knife. Not really in my toolbox. According to our market in a minute now, right? Like I said, we're still looking for the initial low. We're still looking for an initial low, right? I'm not convinced we haven't made the initial low yet. Now, there's some signs of it yesterday, as yesterday's low held Monday's low, but we're trading limit down this morning. And last I checked, the SPY was trading down about 5.5%, 6%. So we may undercut those lows. And it's interesting to me is that we're still groping for those initial lows, despite the monetary and fiscal stimulus that's been announced over the past few days. There's still extreme fear in the market, and that shows no sign of abating. Treasuries are now selling off. We talked about that as investors dash for cash. Fed has actually launched a commercial paper funding facility. Folks, the commercial paper market, where companies go for short-term funding to meet day-to-day expenses like payroll, right? That market is showing signs of cracking, so much so that the Fed has launched a funding facility, and futures trade down by the maximum limit once again. Yesterday was a good day. Today appears to be beginning to not be. Dow adds 5.5%, no bulls, 5 bears. S&P 500, slight improvement, I guess, 6% to the good. 7 bulls, 125 bears. NASDAQ outperformer as it has been through this entire downturn. 3 bulls, 26 bears there. Small caps, underperformer as they have been through this entire downturn. 44 to 506, bulls to bears there. Bonds down tick, sending yields higher. 10-year back above 1%. And, right, it might be you want to get excited about a 6% rally. And while I was somewhat excited, as I drilled down and did my work, I realized that that 6% rally was led by a 13% advance in utilities. I became a lot less excited. According to the Chaikin Power Bar, small cap stocks and large cap stocks are strongly bearish. Major markets strongly bearish. Our stock of the day now, Genworth Financial. This is kind of interesting to me because I don't look at stocks under $5 usually. But Genworth, part of the insurance group, is a very bullish rating due to very attractive financial metrics, very strong price volume activity, very positive expert activity, weak earnings performance, but 20 factors, 5 in each of these categories. Very bullish rating for a stock that's showing increasing relative strength as the market sells off. Maybe I should broaden my horizons. I keep an open mind, right? I generally skew away from stocks under $5 because I at least like to focus on stocks where the institutions are likely to be playing because we want to try to ride their wave as much as we can. But I'll broaden it out here. Genworth looks interesting to me. It's not oversold yet, but I'll add it to a bullish watch list as a name that is held up in the sell-off, right? Increasing relative strength to go with our very bullish rating, increasing money flow above the trend line. Now, there's no real trend here, but we are above that trend line. So it's kind of interesting to me. I'm going to broaden out my horizons a little bit here this morning. We're learning every day. We're keeping an open mind because anything can happen. And maybe that anything that happens is we need to gravitate towards some of these lower price stocks. Turning now to our sector tracker. Moving to the major sectors over the last 5 days. Defense at the top of the list, save for real estate not being there. Staples or defensive area of the market. We highlighted them yesterday in our relative strength work in our note. Healthcare, one of the areas we like. Utilities, we highlighted. Tech, right? Those are the top 4 groups on a relative basis over the past 5 days. All right. Comms, materials, financials, and industrials are middle of the road. Real estate has gotten caught up. The normally defensive real estate is now being caught up in the fact that you can't just blindly own real estate. You can't say to yourself, I want to be defensive. I'm going to own real estate. And this is why I don't like talking about the market. And I don't like talking about just blind sectors. I always think you need to take your analysis a step further, right? Because within real estate, you want to own anything levered to retail. You want to own mall REITs right now, right? Retailers are going to go out of business. Malls are going to go dark, right? You want to own assisted living and senior living facilities right now when the over 60 crowd is most vulnerable to this coronavirus. So you really need to do your work. You really need to take your analysis a step further. I always advocate for that. I think it's silly when people just talk about the market and I'm going to just own real estate. Really? Take your analysis a step further. Discretionary and energy, bottom of the list, right? As you would expect. Restaurants closing down, stores closing down. Energy is just a disaster. All right, our industry in focus today, pharma services, past 6 months, actually been an outperformer, 6.5%. Everybody's power bar is weak. All right, this group only has 1 bull, 19 bears. We want to stay away from Reata Pharma, Aerie Pharma, and Revance, RVNC. You want to focus on kind of, if you're focusing in pharma land, I do actually think some of the better names are actually in pharmaceuticals right now and in healthcare, which is one of the groups that we like. But why not take a look at Biogen? Why not take a look at, Eli Lilly, right? Stocks with bullish and very bullish ratings here at Chaikin Analytics, right? Why you don't need to go bottom fishing in these small cap speculative names, especially when the industry group looks like this, right? I mean, just complete waterfall falling off a cliff. Hard for me to get excited here, especially in light of the fact that as a group, the relative strength is actually starting to wane. It's oversold. Money flow is mixed to bearish. But I mean, yesterday we highlighted Regeneron, right? You have Biogen, BIIB. You have Eli Lilly, right? These are bullish and very bullish names. Focus on the large caps, folks. If you are going to start doing work, look for the relative strength. And I think what you're going to find is that the relative strength is in the large cap spectrum. Turning now to our movers and shakers. Yesterday's S&P 500, gainers and losers. Dow, CEO, stepping up to the plate, buying stock. Sends that stock higher by about 20% on the day. LyondellBasell, didn't see any real news there. Up 19%. SO, that's a defensive play, part of the Utes, up 18%. PBCT came out with their 2020 goals. It's mid-March, so I guess it's time to come out with your 2020 goals. PBCT up 18.25%. ED, part of the utility space that, as we said, rallied over 13% yesterday. ED up 18% on the day as it really is just a flight to safety. Capri, CPRI down 15.75%. Continue to close stores. Darden, DRI, closing restaurants down 15%, just about 15%. ADS came out with some private label data earlier in the week, and the stock is following through to the downside on that data, down 14.5%. OKE, didn't see any real news there, down 14%. And we've said all there is to say about the oil stocks. I'd like to say good things about them, but I can't. As a matter of fact, I gave a presentation last week where I featured FANG as a bearish idea and highlighted the fact that it was still not compelling. Well, there you go. Down nearly 14%. On a day when the tape was up 6%. Let's turn to our charts now. Extreme fear in the market, still. All right, what we're looking at here, as we always do, is the 13-day moving average of the CBOE equity put call ratio, and we've blown out to 5-year highs, right? We were near 5-year highs last week when we were having this conversation. Now we've blown out to 5-year highs. Now a lot of people might turn around and say, Dan, isn't that extreme pessimism? Shouldn't I step in and catch this knife? Why? Do you think the market's going to run away from you? I don't. It's not our base case. I'd rather see this begin to roll over. It's not even rolling over. It's not abating. And this is an average, right? So it's going to lag. That's fine. I'm okay with that. But it's not abating. It's still moving higher. Take a look at the chart of the VIX, right? Read my note today if you get the note or if you've taken our 14-day trial. The VIX is still spiking. The 10-day moving average of the VIX is still moving higher. If you're stepping in, folks, you're catching the falling knife. If that works for you, great. It doesn't work for me. I'm going to wait to see signs of this extreme fear abating. I'm going to wait for signs of a stabilization in the market to let me know that it makes sense to start getting involved. I can't get there now, right? I'd love to see this start to roll over as this level holds. That'd be nice, right? That'd be a nice setup. It almost looks too perfect, right? It almost looks like it would be too perfect of a setup. I don't think we're going to see it today, right? With markets are lock limit down here in the pre-market. So not likely to see this extreme fear in the market abate anytime soon. And now they're selling the long end of the curve, right? So even the safe havens, right, quote unquote, treasuries, they've been sold off. Remember this chart from last week? Remember I drew it with the parabola and compared it to Tesla? Did you take profits in your treasuries then? I hope so. Remember we called this a blow off top? We're now heading lower. Investors are just raising cash. They're just raising cash. It's gotten to the point where, at least in my opinion, investors have decided that cold, hard cash is where they want to be. Right? Look at yields. They're going higher. You wouldn't expect it. Markets lock limit down. Treasury yields are going higher across the curve. Right? Look at the volatility. Look at the one-day volatility of a treasury product. 6% moves in both directions. Give the market time to stabilize. Give the market time to play out. And realize what's going on here. Investors are running for cash. That's what it seems to me. Right now, we might see some stabilization here around the 145, 150 level in TLT, which holds, right? We still want to run through our analysis, but this fascinated me when I ran this morning. The volatility in treasury products, right? But we still have a series of higher lows for the RSI, and we could potentially see some support in the 145, 150 level. Excuse me. In which case, it might make sense to start getting involved again. Finally, cash appears to be king. Here's the dollar. UUP, the Invesco DB US Dollar Index Bullish Fund. Moving higher. Certainly outperforming the SPY. So that's where we are, folks. We're lock limit down. I still think it's too early to reach out and catch the knife. And if I miss the bottom, I miss the bottom. I fully expect to miss the bottom, and I'm okay with that. So if you're interested in following along, take the trial. ChaikinAnalytics.com/test drive. Free 2-week trial where you get my note every day. You get Mark Chaikin's note on the weekends, where we walk through our thoughts and ideas and go through it step by step. Hope everybody has a great Wednesday. I'll be back with you tomorrow.